रयत शिक्षण संस्था, रयत ऑनलाइन स्कूल एजुकेशन, रोज project 2021-22. Welcome to all. 12 Commerce, Bookkeeping and Accountancy. Myself, Mr. Ramesh Narayan Kohli from Karmavir Bhaurao Patil College, Vashi, Navi Mumbai. Today, we do revision topic number 3, Reconstitution of Partnership, Admission of Partner. HSC Board topic weightage, Practical problem on admission of partner.
Question number 2.
Is admission of partner or retirement of partner. 10 marks. And objective questions on admission of partner, question number 1, 2 marks. Total 12 marks. Next, admission of partner key points. Meaning of reconstitution of partnership. Meaning of admission of partner. Needs or reasons for admission of partner. Capital brought by new partner. New profit sharing ratio. Sacrifice ratio. Meaning of goodwill and methods of valuation of goodwill. Average profit method. Super profit method. Treatment of goodwill. Revaluation of assets and liabilities with revaluation account. Adjustment of accumulated profit or loss and reserve fund. Adjustment of capital. First, see meaning of reconstitution of partnership. Reconstitution of partnership means any change in the existing agreement or making of new agreement by the partners is known as reconstitution of the partnership. Such reconstitution of partnership take place whenever there is a change in the profit sharing ratio among the old partners, admission of a new partner, retirement of an existing partner, and death of a partner. Next, meaning of admission of partner. According to Partnership Act 1932, under section 31 subsection 1, a person can be admitted as a new partner only with the consent of all existing partners unless otherwise agreed upon. Next, why admitting new partners? Need or reasons? The following points. Number 1, to expand the capital of the firm. Number 2, to use skills of that persons to improve overall performance of the firm. Next, capital brought by new partner. The new partner will bring the capital in cash or kind as per the terms in partnership deed. Next, the accounting treatment for the capital brought in by the new partner is transactions. Number 1, when new partner bring cash toward his capital. The journal entry, cash bank account debit to new partner's capital account credit. Second, when new partner brings certain asset towards his capital. Journal entry, asset account debit to new partner's capital account credit. Next, how to calculate new ratio or what is new ratio? New ratio, that is new profit sharing ratio. As the new partner is admitted in partnership firm, the profit sharing ratio of existing partners changes and there is need to calculate new profit sharing ratio including new partner. This ratio is used for return of goodwill and capital adjustment. Next, how to calculate new ratio. Step 1, find out balance of 1. Balance of 1 is equal to 1 minus share of new partner. Step 2, find out new ratio. New ratio is equal to old ratio into balance of 1. Or if sacrifice ratio of old partners is given along with old ratio, the new ratio can be calculated as follows. New ratio is equal to old ratio minus sacrifice ratio. See example, calculation of new ratio. Mohan and Ganpat are sharing profits and losses in the ratio of 2:3. They admitted Chandrakant for 1/4 share in future profit. Calculate the new profit sharing ratio. Students, keep it in mind, the formula calculating of new ratio. See the step 1, find out balance of 1. Balance of 1 is equal to 1 minus share of new partner is equal to 1 minus 1 upon 4 is equal to 1 minus 4 upon 4 is equal to 3 upon 4. That is balance of 1. Next, step 2, find out new ratio. New ratio is equal to old ratio into balance of 1. Mohan's new ratio is equal to 2 upon 5 into 3 upon 4 is equal to 6 upon 20. Next, Ganpat's new ratio is equal to 3 upon 5 into 3 upon 4 is equal to 9 upon 20. Chandrakant's new ratio is equal to 1 upon 4 is equal to 1 upon 4 into 5 upon 5 is equal to 5 upon 20. Therefore, new ratio is equal to 6:9:5. Next, sacrifice ratio. When new partner is admitted, old partners have to sacrifice their share of profit to give the share of profit to new partner. This ratio is used to retain the goodwill in premium method. Sacrifice ratio is calculated as per the following formula. Students, keep it in mind. Formula, sacrifice ratio is equal to old ratio minus new ratio. Next example, calculation of sacrifice ratio. A and B are partners sharing profits in the ratio of 6:4. C is admitted as a partner. The new profit sharing ratio of A, B and C is 10:6:4. Find out the sacrifice ratio. Solution. Sacrifice ratio is equal to old ratio minus new ratio. A's sacrifice share is equal to 6 upon 10 minus 10 upon 20 is equal to 120 minus 100 upon 200 is equal to 20 upon 200 is equal to 2 upon 20. Next, B's sacrifice share is equal to 4 upon 10 minus 6 upon 20 is equal to 80 minus 60 upon 200 is equal to 20 upon 200 is equal to 2 upon 20, or sacrifice ratio of A and B is equal to 2 upon 20 as to 2 upon 20 or 2:2, that is 1:1. Next, meaning of goodwill and methods of valuation of goodwill. Meaning of goodwill. Goodwill means the reputation of the firm converted in terms of money. New partner brings goodwill with respect to the efforts taken by old partners for developing the reputation. Methods of valuation of goodwill. First, average profit method. Average profit means the average of total profit earned in last few years. Step 1, total profit is equal to add the profits of the previous year and deduct the losses. Step 2, average profit is equal to total profit upon number of years. Step 3, goodwill is equal to average profit into number of years purchase. Student, see the solve example in textbook page number 129 for practice purpose, and then you have to make use of practice how to calculate average profit and goodwill through by the average profit method. Next, super profit method. Super profit is the profit which is earned over and above the normal profit. Steps for calculation of goodwill by super profit method. Step 1, total profit is equal to add the profits of the previous years and deduct the losses. Step 2, average profit is equal to total profit upon number of years. Step 3, normal profit is equal to capital employed into NRR, that is normal rate of return, upon number of years. Capital employed, how to calculate capital employed? So capital employed is equal to fixed asset plus current assets minus current liabilities. This is a way to find out capital employed, or capital employed is equal to all partners capital plus reserve fund. This is another way to how to find out capital employed. Step 4, super profit is equal to average profit minus normal profit. And step 5, goodwill is equal to super profit into number of years purchased. See the solve example in textbook page number 130 for practice purpose. Find out the value of goodwill from the following information by using super profit method. Year and amount 2014 80,000 profit, 2015 95,000 profit, 2016 1,10,000 profit, 2017 40,000 loss, and 2018 85,000 profit. Capital employed is rupees 3,50,000. Normal rate of return is 12%. Goodwill is to be valued at 2 years purchase of super profit. Then calculation of average profit. So average profit is equal to total profit upon number of years. So first total profit, so is equal to 80,000 plus 95,000 plus 1,10,000 minus 40,000 loss plus 85,000. Then 3,30,000 total profit divided by 5 is equal to 66,000. Then calculation of normal profit. Normal profit is equal to capital employed into NRR upon number of years is equal to rupees 3,50,000 into 12 upon 100. We get the rupees 42,000. Then super profit is equal to average profit minus normal profit is equal to 66,000 minus 42,000 is equal to 24,000. Then last calculation of goodwill. Goodwill is equal to super profit into number of years purchases is equal to 24,000 into 2 is equal to 48,000 goodwill under super profit method. Next, treatment of goodwill, a premium method. Under this method, new partner bring goodwill in cash or kind. It may be retained in business or withdrawn by old partners. Transactions and journal entry. When new partner bring goodwill in cash and it is retained in business, journal entry, cash or bank account debit to goodwill account credit. Second, goodwill account debit to old partners capital account in sacrifice ratio. Second, when new partner bring goodwill in cash and it is paid privately to old partners, there is no journal entry. Third, when new partner bring goodwill in cash and it is withdrawn by old partners, A. Cash or bank account debit to goodwill account credit. B. Goodwill account debit to old partners capital account credit in sacrifice ratio. C. Old partners capital account debit to cash or bank account credit. Next, valuation method. Under this method, new partner does not bring goodwill, but goodwill is raised in the books at the time of admission of new partner. C. Transaction and journal entry. Number 1, when new partner does not bring share goodwill in cash and it is raised, journal entry goodwill account debit to old partners capital account credit in old ratio. Second, when goodwill raised and written off, A. Goodwill account debit to all partners capital account credit old ratio. B. All partners capital account debit to goodwill account credit in new ratio, that is new profit sharing ratio. Third, when goodwill already appear in the books of the firm, in such case the difference between revalued goodwill and book value of goodwill is transferred to revaluation account or old partners capital account. Next, revaluation of assets and liabilities and revaluation account. It includes the change in valuation of assets and liabilities at the time of admission of new partner. Therefore, an increase or decrease in value at the time of admission of new partner belongs to new partner. The change made in the value of assets and liabilities are recorded in revaluation account or profit and loss adjustment account. It is a nominal account. Next, see transaction and journal entry relating to the revaluation of assets and liabilities. Number 1, appreciation or increase the value of assets account debit to revaluation account or profit and loss adjustment account. Second, depreciation, that is decrease the value of asset, entry revaluation account or profit and loss adjustment account debit to assets account. Third, increase the value of liabilities, journal entry revaluation account or profit and loss adjustment account debit to liabilities account credit. 4, decrease the value of liabilities account debit to revaluation account or profit and loss adjustment account credit. Number 5, creating new liability or unrecorded liability. Revaluation account debit or profit and loss adjustment account debit to liabilities account credit. Number 6, recording unrecorded assets account debit to revaluation account or profit and loss adjustment account credit. Number 7, transfer of profit on revaluation to old partners capital account. Journal entry revaluation account or profit and loss adjustment account debit to old partners capital account credit. Number 8, transfer of loss on revaluation to old partners capital account. Journal entry old partners capital account debit to revaluation account or profit and loss adjustment account credit. Next, format of revaluation account. Revaluation account, left hand side debit and right hand side credit. Debit side, to assets account decrease, to liability account increase, to liability new liability or unrecorded liability, to all partners capital account in the bracket profit on revaluation transfer. Second up side, that is credit side, by asset increase, by liability decrease, by asset unrecorded asset, by all partners capital account in the bracket loss on revaluation transfer. Then number 10, adjustment of accumulated profit or loss and reserve fund. Accumulated profit is the profit earned by old partners before admitting new partner. it will be given on liability side of old balance sheet. Accumulated loss is a loss sustained by old partners before admitting new partner. It will appear in asset side of old balance sheet. See the transaction and journal entry. Number 1, transfer of accumulated profit, that is credit balance of profit and loss account. So journal entry, profit and loss account debit to old partners capital or current account credit. Second, transfer of accumulated loss, that is debit balance of profit and loss account. Journal entry, old partners capital or current account debit to profit and loss account. Number 3, transfer reserve fund or general reserve. So journal entries, reserve fund account debit to old partners capital or current account credit. Next, adjustment of capitals. Sometimes capital of all partners are to be adjusted in new profit sharing ratio after admission of new partner. Number 1, capital of all partners may be adjusted on the basis of capital of new partner. In this case, capital of new partner is taken on base, that is base capital, to find out total capital. Formula: total capital is equal to new partner's capital into reciprocal of his profit sharing ratio. See the example, calculation of total profit. Z is admitted in the firm with 1/5 share of the profits of the firm. Z contributes rupees 50,000 as his capital. X and Y, the other two partners, were sharing profits in the ratio of 2:1. Find out total capital or new capital. Total capital is equal to new partner's capital into reciprocal of his profit sharing ratio is equal to rupees 50,000 into 1/5, that is reciprocal 5th upon 1 is equal to rupees 2,50,000. Then students calculate new ratio and distribute total capital to all partners as per new ratio or new profit sharing ratio. Next, capital of new partner may be determined on the basis total capital of all partners. In this case, new partner is required to bring share of capital in proportion to total capital of all partners. New partners capital is equal to all partners total capital into reciprocal of all partners total profit sharing ratio. Note, if total of all partners share is 3/4, that is reciprocal of their total profit sharing ratio is 4/3. See the example. P and Q are partners and their profit sharing ratio of 3:2. They contribute rupees 60,000 and 48,000 respectively. R is admitted and is to be given 1/4 share of profit. He has to bring in capital representing his share, which is explained or calculated as under. R gets 1/4 share, so 3/4 share is left for P and Q. Therefore, the combined capital of P and Q is rupees 1,08,000. That is rupees 60,000 plus 48,000 represent 3/4 share. So, total capital should be rupees 1,08,000 into 4/3 is equal to rupees 1,44,000. Therefore, R should bring rupees 36,000, that is rupees 1,44,000 into 1/4 share of R. See the transaction and journal entry. Journal entry for surplus capital. Concern or respective partners capital account debit to cash or bank or current or loan account credit. Second, journal entry for deficit capital. So journal entry, cash or bank or current or loan account debit to concern or respective partners capital account credit. As per the board pattern, on this topic, we'll ask practical problem on ledger accounts and statement of new partnership firm or journal entries of new partnership firm. Following ledger account statement maintained under admission of partner. Profit and loss adjustment account, that is revaluation account. All partners capital or current account. Balance sheet of new firm. Goodwill and cash or bank account if necessary. or journal entries of new partnership firm. For ledger account, you have to prepare following ledger accounts. The students, profit and loss adjustment account, all partners capital account, balance sheet of new firm, goodwill and cash bank account if necessary. See, the textbook problem and solution, page number 145 and 146. The balance sheet of Bhavesh and Chandra, who share profit and losses in the ratio of 3:1 as on 31st March 2018, was under. Balance sheets given, and then adjustments. Alia was admitted on 1/4/2018 for 1/4 share on the following terms. Then here mention, prepare revaluation account, partners capital account and balance sheet after Alia's admission. So this problem asks ledger accounts and statement of balance sheet. Then solutions, revaluation account, then partners capital account and balance sheet of new firm. So this is a way to solve. In board as suppose ledger accounts and statement. So revaluation account, partners capital account and balance sheets of new firm. Then scheme of marking above answer ledger accounts and statement of admission of partners. So profit and loss adjustment account 5 items, 1/4 mark each. So we'll get the 1.5 marks. Then partners capital account 14 items, 1/4 mark each, excluding opening balance of partners, old partners capital. So we'll get 3.5 marks. And balance sheet of new firm 10 items, half mark each, including all partners capital, get 5 marks. So total 10 marks as per the scheme of marking. Then see the page, journal entries. Problem and solutions, page number 137 and 138. And here last pass the journal entries in the books of the firm. In this problem asks journal entries. So students, be careful while you solve the admission of partners. Read the questions or problem carefully. What question asks? Ledger accounts or journal. So in this problem, ask journal entries in the books of the firm. So you have to prepare journal entries. So be careful while preparing this journal or ledger accounts. See the journal entries in the books of the firm. First slides 1, 2, 3, 4 journal entries, and second slide again 4 journal entries. And see the scheme of marking above answer journal of admission of partners. Journal entries number 1 to 4. First slides number 1 to 4. 1.5 mark for each correct entry. Get the 6 marks. And second slide journal entries number 5 to 8. 1 mark for each correct entry. We get the 4 marks. So total 10 marks journal entries. Then students, today we revise how to get maximum score in admission of partner topic. For your practice, solve unsolved practical problems in given textbook. Students, all the best for your board exam. Thank you.